good morning, good afternoon, good evening, wherever you're listening to me. Welcome to another episode of Wealth Building Conference. Tonight, we're going to be looking at how you can, how to use your retained earnings. So that's what we're going to be discussing today. But before we go into the program, I just want to say thank you so much for everyone who have been part of this program. So this is 2026. We started this program since about a year ago, and it has become a ritual. Like every Friday and Saturday, we meet to educate ourselves on how to build wealth and also to pass it on. Right? There is difference between building wealth and pass it on. Like I've seen a lot of people, right? They have so much money, but when they pass, they have nothing to show. The family is still struggling financially. So the goal is for us to educate ourselves on how to build and pass it on to the next generation. So as you are joining, please, I want you to put on the comment section where you are joining from and your name. We just want to know you. Of course, it's going to be an interactive session, right? So if you know any medical professionals or business owner, right, who want to build wealth, but most importantly, also pass it on to the generations, this might be another game changers in their life and in their business. Please encourage them to join. We're going to learn a lot today, right? So, again, we also want to let you know that we're going to be having a series. All right, we're going to be coming up with a series for medical professionals and entrepreneurs. So that series, we're going to start it in a couple of months from now. I will tell you what we are going to do in the series, what it's all about. It's going to be just business, medical professionals, and entrepreneur series on a strategic way of how to build wealth and pass it on, right? So once again, you're welcome, right? I'm going to quickly pull up my slide and we're going to the presentations tonight. I know a lot of people are excited to learn about how to actually use retain any. It's just an important topic that I want everybody to focus on. Even if you're an insurance advisor, you're a financial planner, as long as we have a corporation, okay, and you are making money, all right, it is important for you to listen to this amazing training. It's going to help you a lot. It will expose you and open your eyes to different strategies on how you can actually use your retained earning. Right? So let's dive in. Okay. Once again, welcome on board. My name is Oludare Fasola. All right. So let's look at how retained earnings should be used. Right? We're going to be looking at tax deferral versus tax strategies for medical professionals. Of course, if you are not a medical professional, but you're a business owner as well, you have your corporations and you are making some money, right? You have a lot of money sitting down in your corporation. This is, this training will expose how you can actually strategically use your retained earning. Let me ask you this question before we proceed. You work hard to earn it, right? But is your retained earning actually working for you? This is the question I ask a lot of medical professionals and business owners, right? When you make money from your corporation in Ontario here, your first $500,000 will be charged about 11.5 to 12%, right? Depending on your province. But in Ontario here, your first $500,000 will be charged at about 12%. What do I mean by that? Let's say, for example, you make $700,000 in your corporations, you claim your expenses, you pay yourself salary, gas, payroll and whatever, right? The remaining, let's say out of those $700,000, your expense is about $20,000, right? The remaining $500,000, it's what we call retained earnings. And I'm going to break it down in a layman format, what retained earnings simply is. But I'm just using that as a practical illustrations of how retained earnings actually been determined, right? So in Ontario here, your $500,000, your first $500,000 will be taxed at 12%. But what happened to that $500,000 is another conversation that we're here today, right? The reason why we're doing this today is what happened to that money that is being taxed, right? What after to your money after tax dollar from your corporation? What happened to it? So most medical professionals earn high income. They incorporate for tax reasons and accumulate retained earning, but very few use retained earnings strategically. Many people believe that once I incorporate at least I will save as much money on taxes. The answer is yes. But you know what? If you save so much money, if you incorporate, what happened to that money that is sitting down in your corporation? Okay. Retained earnings can either quietly grow your wealth or quietly become a tax trap. Like, there is difference between tax deferral and tax strategy. So I'm going to explain the two part to you. Now, let's look at what retain earning really mean. What is retain earning? Okay. Retain earning is after tax corporate money. It's money left inside your corporation after expenses and corporate taxes. I'm going to come back again. I'll explain this in a way that it will be very clear to everybody listening to me. If you are getting value, please put in the comment section, I'm getting value. Right. Retain earnings simply means that you have a corporation. Like, I'm an insurance advisor. I have my own corporation. Okay. I have my corporation, Vast Financial. If Vast Financial, let's say, for example, in a year, I make, let's say, $500,000, right? And I pay myself salaries. Probably I take some dividend out of the corporation. I claim maybe traveling expenses, telephone expenses, insurance. Maybe I have some couple of assets and I depreciate that and I write off to my corporations. All those expenses, right? As long as it relates to my business, telephone expenses, as long as advertisement expenses, those are the very big expenses that I incur when I'm running my corporation. So say, for example, I make $500,000. Let's say, for example, my expenses in a year is that what is going to my profit and loss is, $200,000. So the remaining $300,000 will be taxed at 12%. Okay, so say, for example, 12% multiplied by whatever amount that is. Let's say, for example, my profit is 250,000. That is what retained earnings simply means. So your retained earning is less expenses, apply your corporate taxes, the remaining balance is what you call retained earnings. Now, CRA, not taxed personally yet. So CRA is simply waiting for that personal withdrawal. So when you have is retained earnings. So the question is that how do I actually strategically make sure that this retained earning is not subjected to another taxes? Because either way, you're going to spend that money. You can't have money in your corporation and be looking at, and I've seen a lot of medical professionals. They have retained earning, but they don't know how to pull it up. But I have an answer for you today. Okay. Now, important mindset sheet is this, right? Not saved taxes, they are deferred taxes. Like I mentioned to right, there's difference between tax deferral and tax strategies. So I'm going to break down to. So if you let your retained earnings sitting down in your corporation, like you are simply deferring taxes, right? Because those retained earnings will be sitting idle. Why business owners and medical professionals accumulate retained earnings? Number one, they want to avoid high personal tax rate. Now, the reason why you actually put that money there, because if you go back and pull out that money again, you're actually taking another dividend, which can be subjected about 50 to 53% taxes here in Ontario, depending on your profit, depending on your province. Okay, small income over time. So you actually decide when to pay yourself. That is what smooth income over time simply means. So it means that you want to know, like, if I want to take actually money from my corporation, when can I take money out of my corporation? So you can decide when and how I can take money from my corporation, delay personal withdrawal. So, the reason why you accumulate this money is because you want to delay that withdrawal to a later date. Probably you are waiting for when the tax will go down. Of course, I want to ask you this question. Do you think, since I've been to this country, right, I've never seen when CRA will say, okay, we want to reduce taxes this year so that people can have, no, taxes will continue to go higher. Then reinvest later. Now, this is a very big challenge for most medical professionals. So there's what we call passive income taxes. Okay. Passive income taxes arises as a result of you investing your retained earnings right? If, for example, you make $500,000 from your corporation and you invest that money, let's say you put that money on rental income, you put it on real estate. Okay. Now, if you put it on real estate, you buy a house of $500,000, right? So that house, you put it on rent. Okay. Now, the rental income you actually get from that corporation, okay, will still be subjected to taxes. So because you are making money from from that house, you pay tax on the rental income. Now, another problem now is that what happened to that money, okay, when you later sell the asset? If, for example, you have $500,000, you purchase a property of $500,000, and that property, maybe 5 years, 10 years from now, that property go to $1 million, for example. So it means that you make a gains of $500,000 on that money, right? Divided by 2, multiplied by 50%. That's what CRA will be expecting. So this is a very big challenge for most medical professionals and business owners. So you want to know, how strategically can I put this money into use without me incurring another crazy taxes? Because tax, I do say this, tax is number one biggest resource of wealth. If you don't know how to properly manage your taxes, it's going to be very difficult for you to build wealth. Now, many stop at deferral and never move to strategy. This is what, like, people like feel that, oh, when I delete money from taking money out of my corporation, I'm going to at least save some taxes. You are delaying that taxes to future. So you are actually allowing CRA to like wait for you and take that money out. Let's look at tax deferrals versus tax strategies. Okay. So when you are deferring taxes, means that you allow your retained earning to sit idle in your corporation. That is what tax deferral means. Okay. And again, it means that you're actually using a short-term delay for CRA to collect that money later. That is what tax deferral means. But what about the tax strategies? Okay, tax strategies. So you plan strategic requirement, retirement, and legacy planning. So you actually put that money into use for you to plan for your retirement and also to pass it on to generations or more. Like, if you have so much money, there's difference between wealth protections and wealth preservation. Okay. If you are deferring it, probably you are preserving that wealth, but without protecting it, right? That is when tax strategies come in, right? You want to make sure that after tax dollars you have in your corporation, how do I strategically, intentionally invest this money in such a way that I'm going to have a lot of money sitting down for me for retirement planning, for me to go into franchising or create another streams of income, right? I'm going to be teaching us some videos on analyzing it on whiteboard on how you can actually invest your retained earning in a tax efficient manner. Okay. Now, tax strategies also mean that you structure your corporate planning. Many of us have a lot of money, but how well did you structure this? Okay. How well did you structure this? Tax deferral simply means, okay, simply delaying personal tax, money sit idles or poorly invested, no long-term outcome plan. That is what tax deferral means. You are deferring your taxes till probably anytime you want to take it out. And guess what? The more you defer this, the more you defer this money, the more you allow CRA, because they will be waiting for you to take that money any day, anytime, or use for investment, and they expect you to come and pay that passive income taxes. But this is tax strategies, okay? Intentional, structure, forward-looking, plan for retirement, estate, and legacy planning, control when, how, and how much tax is paid. You can see the difference between tax deferral and tax strategies. All right. So you need to understand one thing, right? What strategies am I using for my corporation? Am I deferring taxes, or am I strategically invest my retained earnings? Deferral by time, strategies by control. That is very, very profound, right? So if you are a business owner listening to me today, the question is, how do I actually invest my retained earnings? And it's a very hard conversation, because I've spoke to a lot of business owners and medical professionals, and they say, look, I'm going to talk to my accountant. Unfortunately, your accountant cannot really help you. how strategically you can invest your retained earning, because your accountant also come to us to ask for advice on when and how can we invest their retained earnings. So you need to sit down and ask yourself, how well, strategically, intentionally do I actually want to invest my return in it? Deferral buy time, strategy buy control. If you agree with me, put it in the comment section and agree. Okay. This is the hidden risk of doing nothing. So if you are actually sitting out today and say, look, whatever happened, I'm going to leave this money there. Some people say, well, as long as I don't take it out, I don't pay the taxes. Well, if you don't take it out, you don't pay the taxes. But you're going to take the money out one day. If you don't take it out the day you pass, I'm going to talk about deemed disposition when I get there. That will also happen. You're still going to pay that taxes. So it's better you deal with it right now. Passive investment rule. So I actually have a conversation with one medical professional last year that we're doing analysis on. He said, Mr. Fasola, I have a lot of money in my return earning. And I kind of look at how to invest your return earning. And we're looking at two different strategies. Like if you put this money on, let's say, mutual funds, or you put this money on real estate, or you put this money on whatever investment, let's say stocks, right? And this money continue to grow, okay? Continue to grow. Now, let's say, for example, you put $500,000 into investment, real estate, and 10 years down the line, right? That money double, right? It means that you have a gains of $500,000 on that money. That is, and in Canada here, so once you pass, if it's a corporation, once you pass $50,000 of gains, so you are expecting, CRA is expecting to come and pay 50% taxes. So it's going to be withholding taxes. So divided by 2, whatever the gain you have, divided by 2, multiplied by 50%, CRA is expected to come and pay that one. So I kind of look at, and I show him, right? Say, doctor, if you put your money here and your money double in the next 10 years from now, you pay 0 tax, right? You pay 0 tax. So, but if you put this money here, the money double in 10 years here, you pay 50% of the gains, right? So whatever gains divided by 2 multiplied by 50%, that's what CRA is expecting. Refundable tax increases. So you're actually risking you to refund some taxes later in futures. And of course, estate tax exposure, right? There's what called deemed disposition. Okay, deemed disposition means that some of us, right, when they do the evaluation, let's say they value your investment, right? So you have real estate, you have bonds, you have stocks, you have franchising, you have different money in different investment. Let's say, for example, you start those investment at $5 million, and that money grew to about $10 million, and life happened to CRA. Okay, it means that the day you pass, CRA assume that those assets is deemed to be disposed, and they will expect you to come and pay gains on it. Many of us did not plan, because you are just acquiring assets. You are acquiring assets. You are getting this one. You are getting that one. Did you have strategies in place to make sure that everything I've actually acquiring, I have enough money to take care of the taxes? Debt creates massive tax leakage. Now, if you pass, right, everything become like they have to value it, and they have to calculate the taxes, and you have to pay that. And you know what? It is a mandatory, it's a law. You have to do it. So it is better you deal with it now than for you to continue to defer it, and create another bigger problem for yourself. Unplanned retained earning often create the largest tax bill at death. I watched a videos one day of one individuals that actually, right, pass away, and CRA asked them to come and pay roughly about $600,000, I think, right? So that is what can happen when it comes to when you don't plan for when you don't plan for this. This is where many families lose hundreds of thousands unnecessarily. Like, a lot of people lose millions to taxes here. How I help medical professionals use return earning properly. This is the strategies that actually, use. Last year, we have actually adopted, and it's working, because why? I could see them come back with feedback, say, look, we have been able to put our return earning to work. So number one is tax efficiency. We minimize tax burden through strategic planning. Like, we put your money in a tax-free growth investment. Okay, meaning that if, for example, you want to go into real estate, okay, we make sure that we put this money where you can also have access to that money and use whatever you want to use. We also make sure that we create liquidity, ensure accessible funds when needed. Like, we're not going to make you to put the money to works, right, and not have access to your money. As the money is growing, okay, you also have access to that money. For example, you want to go into real estate, you want to go into another type of investment, you have enough money for this, right? Long-term certainty, we create predictable financial outcome. So, this we have put this money into a guaranteed tax-free environment in such a way that it's not going to be subject to market volatility. Like, the market is up, it's not good subject to the ups and downs of the market. And this is the big thing. Like, we help our, business owners and medical professionals to achieve, right? And, if you think that you want to delay this, right, you are giving yourself, you are giving CRA that opportunity to come and take the bigger chunk of your retained earnings. So estate preservation, we protect wealth for future generations. So, there's like I said earlier, there's difference between, wealth protections and wealth preservation. We don't just protect these retained earnings, but we also make sure that this retained earnings is also passed on to your, generations unborn. Right now, the practical strategies for retained earning. These are the practical strategies that we actually use. Number one, we create what we call corporate owned strategies life insurance. So this strategies is built around your holding company. So it's going to be in the center of your holding company, where you can actually use to go into different, strategies. I actually created two last year for two medical professionals. They are super excited about it. Say, look, we have been looking for this kind of arrangement, because they just have this money sitting on their corporations. They don't know how to go about it. So we put it in a corporate life insurance, and this was going to be set up on the holding company, not your medical corporation. Okay, so there are two ways in which you can set up a life insurance policy. Either you set it up on your medical corporation, or you set it on your holding company. So in this kind of arrangement, it's going to be on your holding company. So the holding company will be the one, have access to this, so that they can actually use it for some other thing. Number two, okay, we actually use it to create retirement income planning inside a corporation. Let me tell you that your medical corporation is your retirement engine. So make use of, but most time, many many medical professionals and business owners don't really know how to do that. So we create it on your holding company, and we also structure it in such a way that it can actually create, retirement planning for you. Now, I'm going to quickly talk about this interest deductibility when it comes to, creating this strategy. So the question now is that the interest on those, money you borrow from your, the corporate owned life insurance, the interest can be claimed. Now, there is a rule for that, right? So the interest, if you want to claim the interest, it must be for the income generating asset. Let me repeat this one, okay? If you want to claim interest on your corporate owned life insurance, it has to be interest generating income. For example, you borrow money from your holding company, which is the strategies, and you put that money into real estate, and you are getting some form of rental income. Yes, you can actually write it off to your profit and loss, right? So you debit your interest on loan on your profit and loss in your corporation, so your accountant understand all of that. So those are the things. You don't need to worry about that. But you know what, you need to understand a little bit of figures when it comes to this thing. Because why? You don't want anybody to come and bamboozle you, tell you that this is not possible. Because I've spoke to some corporate owners, medical professionals, they say, look, I'm going to talk to my accountant, and unfortunately your accountant don't really know how this strategy works. But we can educate them on some of the treatment and how to properly structure it in such a way that it's not going to trigger taxes. It will help you to plan for your retirement, and it will help you to build wealth going forward. Okay. 3, estate planning smooth. So we also need to decide when to take money from you. Instead of you to go directly to the retained earning and be pulling the money out, put it on a corporate owned life insurance policy, borrow against this, okay? Use whatever you want to use it for, and that money will continue to grow there. It's just like you eat your cake and you still have it. Control investing versus passive income traps. So now let me tell you this, right? Now we run a illustration for 10 pay on these strategies, right? For $100,000. So honestly speaking, at year 10, that money already doubled. Like this particular medical professional put $1 million in the strategies, and at the 10th year, that money is doubled, tax-free. Plus, you also have access to your money as you are putting the 100K in. You can borrow the money, let's say from year 2, and you're paying 4.9% or 3% interest rate that you can still be written off to your corporation as long as you use that money for income generation asset. Okay? 3. Now, so when you look at this, right, if at the 10th year, right, you put $1 million in the strategies and you have $1 million, meaning that you've gained $1 million from that investment. That's what it means, right? If it is not in these strategies, if it is maybe on real estate, it means that you're going to pay passive income taxes, right? So in this kind of arrangement, you don't pay tax. If you're to calculate passive income tax, you're going to pay here $1 million divided by 2 multiplied by 50%. That's roughly about 250,000. That's what CR will be expecting from you. So it's just about education, because honestly speaking, if you don't understand how to properly build wealth, if you don't understand how to properly manage your taxes, it's going to be very, very difficult for you to build wealth. Funding opportunity outside your medical corporation. Like, you know what? One of the advantages of setting up this strategy is, number one, it is creditor proof and it also safe from litigation. And of course, by law, you are not expected to do anything within your medical corporation. So your operating companies can only, you have to focus on your medical practice. But outside the medical practice, you can use your holding company to go into franchising, to buy other form of investment, to do your real estate and all of that. This will give you an opportunity for you to build wealth outside your corporation. Plus, it actually creditor proof and it's safe from your litigation. So one single case can consume all the corporation, but if it is on the holding company, it is actually safe. Okay. Wealth transfer planning for family, right? You know what? You enjoy whatever you want to enjoy. At least we run our illustrations at 85, which is average mortality age in Canada here at age 85. This particular medical professional still have about $6 million sitting down in the corporation. This money can be actually used for retirement. If you start taking money out from age 65, whatever you enjoy to maybe 85, 90, right? Whatever that is remaining can be used to pay whatever capital gain taxes you have. Plus, that one will also go to your capital dividend account, and from the capital dividend account flow to your beneficiary tax rate. That's amazing. That's a very Tell me, there is no other asset in this country that can give you an opportunity to do this. The goal is not just growth, it's efficient growth. So these are life scenarios I've seen in practice. Okay, so what they do is just to get money from their retained earnings. They go into franchise, they acquire or invest in franchise opportunity. Okay, they also go into partner ventures outside medical corporation, and that one creates a income streams, and that actually pass to the legacy. But in this case, before you go into franchising, we build what is family bank for you. From there, you pull money from there and do all of this. So this is what we did for a medical professional last year. I did 2 last year for them. They're super excited about it. If you want to learn more or you want to know how this strategy works, book a free strategy call with me. I'm going to walk you through at no cost to you, walk you through and show you how I've been helping other medical professionals to build up. But only when structured properly. Otherwise, taxes erase the upside. And if it is structured properly, then you really have something to pass on. If it's not structured properly, it's going to be a very big challenges for you. Why this matter more for medical professionals? Number one, right? Medical professionals fall into high tax rates, face steeper tax brackets than most. Like an average medical professionals in combined taxes, if your income is not structured properly, you pay between 40 to 50% taxes if your income is not structured properly. Again, a large corporation, complex corporate structures require expertise. So this is not just this cannot be handled by just ordinary insurance or financial planner. So it must be somebody who understand your practice and know how it works, right? So I've been working with them a couple of years now, and I know what is the pain point, how to really help them to structure it in such a way that it's going to protect you while you are alive, give you money, the liquidity you want, pass it on to your generation. Okay. Significant assets need careful planning. So if you have a lot of asset, you have a lot of money in real estate, you have businesses, you need careful planning, because those gains that's going to be triggered when you pass need to be taken care of. So, and you don't want to, you don't want to sell those assets, to pay those, those taxes. Okay. Long any years, decades of accumulations require strategy. So if you have a lot of money, your retained earnings, it must be structurally, intentionally planned in such a way that it's going to continue to generate another streams of income for you. Okay. Significant debt tax exposure. Like I said earlier, there's what called deemed disposition. If you pass in this country, whatever you have to CRA, it is, to them, it is being this, like, it means that you've sold those assets. So they want to expect their gains. Like, you have to pay that. If you don't have enough strategies in place to take care of those assets, you probably may be forced to sell those assets to take care of the taxes. The more you earn, the more dangerous bad tax planning becomes. So you have to sit down with people that understand your situations to plan something to put something in place for you to take care of the the estate planning, your retirement, and or whatever taxes that actually, and even while you're alive. This is why generating advice for medical profession. This is what I want you to. So retained earnings should never just sit, they should protect, grow, and eventually transfer efficiently. If you want to understand this, right, the difference between tax deferral and strategies, what applied to your corporations, how to use retained earning intentionally, that conversation starts now. Let me ask you this one as I close. Let me ask you this question. How many of you know exactly what happened tax-wise to your retained earning if something happened to you tomorrow? That brings my presentation to end today. I want to thank everyone that has joined this conversation. This is amazing, amazing conversation. If you get value for this conversation, I want you to please put on the comment section value. If you get value, please put in the comment section value. If you have any question, please let me put it. Let's know. Like, if you have any question, please put it on the comment section. If you have any question, thank you so much for joining. This is amazing, amazing training. Honestly speaking, I just wish that this medical professional will understand that some of them are sitting on a keg of gunpowder because they leave a lot of money on their retained earnings, and they are kind of like looking at, how do I actually put this money to works, right? This money just sits idle there. Once again, thank you so much for joining tonight. Next, we're going to be looking at another topic that borders on how to build for medical professions and business owners. And if you have any question or you want more clarity, you have medical professionals and they have a lot of money in their retained earnings. They want to make sure that they put this money into works without being subject to huge taxes. Book a clarity call with me. I'm going to walk you through it's like I love doing it, and I want to help them to save as many of their money from taxes. Thank you so much. See you next week. Bye for now.